Well, good afternoon, everyone, and welcome to our 2023 first quarter market update and outlook webinar. So my name is Dana Vosburgh. I'm the Managing Director of Advisory Services here at Manning & Napier, and I'm happy to be joined by Chris Petrosino, Managing Director of our Investment Policy Group. Chris and the Investment Policy Group are responsible for setting the firm's overview on our broad macroeconomic outlook globally, as well as on global financial markets, both equities and fixed income, and also on asset allocation decision-making. Thanks for joining me on the webinar, Chris.
Good afternoon, everyone. It's great to be here again.
And it would be great to know where everyone is attending from today. So if you wouldn't mind, type in your location in the chat section that you'll see available to you. It's always interesting to know, really where people are maybe tuning in from, so to speak, and who are reaching. So please, type in some of your locations. I see a bunch of them coming in now, all over the place, which is great. Thanks for doing that. All right. Well, we have a lot of good information to cover today, and first we're going to discuss what we're seeing in the U.S. economy and how that's impacting equities and bond markets. We'll then briefly discuss performance while providing some color on our current positioning in our portfolios. And finally, we'll leave some time at the end to take questions that are submitted through the Q&A feature that you'll see at the bottom of your screen. As we start with what we're seeing in the economy and the markets, there's some really, and we've been seeing mixed signals. And we're seeing signs of stress in the economy, much of it by design, by what the Fed is doing and their efforts to increase rates. However, really we've seen challenging performance last year, where the S&P 500, just to use an example, was down roughly 18%, and fixed income was down double digits as well. Pretty much, every area of the market was down. The first quarter of this year was actually quite strong in the markets, and with the S&P 500 nearly up 6%. Meanwhile, we have an inverted yield curve and a number of economic indicators pointing toward some tougher times ahead, and some of those are growing. So I think if we start with a statistic that most people are going to be familiar with, it's unemployment, and we'll just start here. So that's in 2022. It was a year where the Fed was tightening aggressively, as I just mentioned before. The Fed was raising rates over 400 basis points over the course of the year last year, focusing on getting inflation under control and really slowing the economy. So despite this, really employment, I should say, remained strong through the first quarter, as you can see in that 3.5% number there. However, it's important to note that it really serves as a lagging indicator for what the economy might be experiencing. You can see in this chart here, this historical chart, pretty consistent over time. Unemployment was low before the gray bars, which indicate really when a recession comes in, and then a sharp increase in unemployment during and after the recession. So Chris, when you see a chart like this and just think about where we are right now with the market and the cycle, what are your thoughts, I guess, when you see that?
Sure. So I think this chart reinforces the idea that the unemployment rate is a great picture, or great data point for telling you where you've been. It is what we would consider in the business to be a lagging indicator. When we think about different signals, different measures of economic activity, unemployment is one that really doesn't start to get bad or become problematic until there's real pain in the economy. And that really is because we think about how companies make decisions. When things start to slow down, your first instinct is generally not to go and reduce your full-time labor force meaningfully. Instead, what you start to do is look for ways around the margins to cut costs, and generally you do those steps first before you resort to laying off workers. Particularly, we think in an environment like today, where there is arguably a structural shortage of workers, and given the costs to acquire and train new employees, companies are going to be reluctant, we think, to let them go until they absolutely have to and have no other choice. And so instead, for us, we like to look at we consider some of the more leading elements of the labor market. If we go on to the next exhibit here, two of which are overtime hours and temp staffing. And here we just look at the year-to-year change in both of those measures over time, and these tend to lead the broader economy and trends in overall employment. Which again, I think it makes a lot of sense if you're a business owner and things start to slow. What are the first things we do? The first things we can do are decrease overtime, because we just don't need to be running our factories or our businesses at full capacity and then some. And then similarly, you can cut back on temp staffing. And that's what we're seeing. Our expectation would be from here that some of these signals would start to broaden out. And indeed, we are seeing some additional leading indicators of what we think is likely to be some further softening in the labor market. For example, layoff announcements continue to trend higher, and late last year, early into this year, those layoff announcements were really concentrated in some of the those areas of the economy that grew the fastest following the onset of the pandemic. I think about areas like technology and all sorts of things that were piggybacked on work from home, work remote type trends. And layoffs happened there first, which makes sense, but now we're seeing it really broaden out across the economy. So we think the leading signals from the labor market are pointing in a direction which is additional pain. If we just go back to that last slide for 1 second, what I would note with unemployment is once you get into recession, it is not uncommon to see it jump up significantly and jump up very quickly. And the other thing I would just point out while we have this chart up is further reinforcing its role as a lagging signal in the economy. It's also worth noting that many times unemployment doesn't peak until you're on the other side of those gray bars, which is to say the recession is over. So generally, we don't look for rising unemployment to give us a sign that risks are building, because they've already built. And similarly, we don't wait for unemployment to return to more normalized levels to declare an all clear. Another example of leading factors that we want to look at is gauging sentiment of small business. And over the past several webinars, we've featured a number of charts from the National Federation of Independent Businesses, sort of the small business organization here in the U.S. They do a great survey of their members on an ongoing basis, asking all sorts of questions, really trying to gauge where is your business and where is it going. And here we just look at the share of respondents saying that earnings are better versus worse than they were 3 months ago. And it's, I think, really notable that we have seen a pretty pronounced drop off in small business earnings over the past year plus. It's a fairly volatile series, but the data, I think, is pretty clear as far as some of the challenges facing small businesses.
Right. And Chris, when we meet with our clients recently, certainly more recently, we have a number who are small business owners, and they really are very conscious of the headwinds developing. And I think the impact of inflation over the last several years as that's grown and increased costs and expenses, but then also really higher rates taking hold as interest rates have moved up, those are now being felt. And as a small business, it's particularly difficult because you can't absorb maybe some of those costs, those increasing costs, like perhaps you could if you were a larger business and maybe a little bit more flexibility there.
A great color. Thank you, Dana. In addition to facing higher rates, another thing that we're starting to see companies dealing with increasingly is just a tighter credit market, increased difficulty obtaining credit. This exhibit here is from the Fed's Senior Loan Officer Opinion Survey. goes out to loan officers across the country, and again trying to gauge what are lending conditions like, what are your underwriting standards, and so here we're looking at lending standards for commercial and industrial loans. So think business loans here, and again this is the net share of respondents that are reporting tightening standards. So they are more restrictive, more demanding on their underwriting criteria than they were the last time they were surveyed. And what I think is really, really notable here is this survey comes out on a quarterly basis, and it's sort of off month. So it's January, which is the last data point that we have here, which is to say that we have not captured in this chart the events of March with some of the stress in the banking sector, particularly around Silicon Valley Bank and a couple others. And so, our expectation is once we get to the next tick of data here for the April survey, which will actually come out in mid-May, we would not be surprised to see lending standards, tighten even further from here, and that's sort of backed up by some of the narratives that we're seeing in some of the other commentary that we that comes across our desk. Dana mentioned the backup in rates and impacting businesses. Another place where it is having an impact on the economy and has already had a very pronounced effect is in the residential real estate market. Last year at the start of 2022, 30-year mortgages could still be had for around 3%, and then quite suddenly as rates moved higher across the fixed income universe, mortgage rates were no exception, getting to a peak just north of 7% heading into year end, and we've percolated back towards that seven handle more recently. And it's really, I don't think much of a surprise that as mortgage rates have increased dramatically, we have seen housing activity really grind to a halt, and that's the dark green line here, existing home sales expressed in millions on the right hand axis on an annualized rate. And the magnitude, the speed of that downturn is really, you go back to 2006, 7, around the last real housing bust in the country, to find something similar. Now, I think the good news this time is the underlying health of the market is a lot better, where we don't have all of the shenanigans involving low doc, no doc loans, liar loans as they were called, where there was no income verification. Subprime lending has remained very much at the margin throughout this housing cycle. Underwriting standards quite strong, and so what we are seeing this time has been home prices holding up considerably better, but just home inventory drying up. Folks now are, I think, less likely to buy that house you've had your eye on, in the neighborhood over, let's say, if it ever came up for sale, given you might be walking away from a 3% mortgage in exchange for a 7% mortgage, and having to pay a pretty high price for that real estate. So what I would consider the more discretionary housing turnover has slowed, and it's really more around life events. Folks needing more space as a family grows, downsizing as folks move into retirement, perhaps a change of jobs to new cities, things like that. But outside of that, housing activity is has been rather constrained. And as we'll touch later, we're actually seeing that creating some opportunities on the equity side as we look across the investment universe for potential opportunities.
Yeah, and if you aren't expecting to move anytime soon and don't need a mortgage, or you're really a loan of any kind, you might not feel the impact of some of this. In fact, if you're a retired investor, higher rates can be helpful and a good thing for you. So it's a little bit of a different mindset than what we've seen in, I guess, certainly over recent years. And those higher rates can take the burden off of your equities in your portfolio that have been really required to do all the work of the growth in your portfolio. So I think that leads to another topic or point here where, as far as interest rates go, and on this slide, you can see the current state of where interest rates are. And this is the yield curve and some information kind of providing some detail there. There's been a lot of focus in the news recently, especially if you're a regular watcher of CNBC about inverted yield curve and what that means. And typically a yield curve shows rates going up as you move out on the yield curve, longer term bonds, and that would be a normal yield curve. An inverted yield curve is one where the short-term rates are higher than longer-term rates, and you can see short-term rates currently in that line graph are significantly higher, over the very recent or near-term bonds, say, less than 2 years, that are higher than the longer-term rates. So this isn't necessarily very common. And it's been a strong predictor of a recession being on the horizon. And the graph at the bottom shows the green shades there of when that green dips below 0 is when you have actually the 10-year treasury having lower rates than a 2-year note. So you can see kind of the magnitude of where it typically is, and I guess how it can be rare that is actually dipping below the point where the 2-year is actually at a higher rate than the 10-year treasuries. So Chris, what do you think when you see something like this, and what does it mean to you?
Sure. So I think very simply, the yield curve is really a reflection of the bond market's expectations of where short rates are going to be, where the Fed funds rate is going to be at different points in time. And sort of you can go back to finance classes, and you can basically deconstruct any maturity bond into a sequence of shorter maturities, and it's just the yield on that bond reflects sort of the market's expectation of, on average, where are yields going to be over the life of that security. And what an inverted yield curve tells us is the market's expecting lower rates in the future, and typically rates are lower when nominal growth is lower, which is to say both the real component of GDP, which came in this morning, I believe at 1.1%, starts to fall, as well as inflation. So the market is expecting slower activity, slower growth. And generally, when you say slower activity, slower growth, that tends to translate into recession. And when we look back historically at when the yield curve, if we just look at that 10s twos example that's in the lower half, when that goes negative, that's lined up really well with periods where we have ended up in recession. It's got a pretty good batting average. It's I think one of the stronger indicators historically. And now I think is a good time to start segueing to the markets a portion of the discussion, which at the end of the day is really, as investors, what we care about. We don't invest in what is GDP going to be next quarter or the quarter after that. Instead, when we make investment decisions, it's around what are the opportunities in stocks, buying individual companies, and similar calculus for bonds. And if today we were in an environment where, in our estimation, the market had really sniffed out the risks that we were talking about, and let's say that expectations, earnings, a great example here. We have earnings expectations for the Russell 1000, which is just 1,000 largest companies in the U.S. If expectations for earnings, were, instead of down modestly like they are today, down, sharply, as we saw, in prior recessions, if that was the case, and we saw, stock prices materially lower, valuations materially cheaper, if we were seeing those types of things, we would be very excited. We'd say, look, you know what, it looks like a recession's on the horizon, and the market is there with it, right? Expectations are really low, and now is the time to start building exposure to stocks, and likely other areas like high yield bonds, maybe some investment grade corporates as well. But that's really not the case today. We think there is a meaningful disconnect between the various signals that we're seeing from on the economic front versus where the markets are. This chart here, like I said, was earnings per share for the U.S. market over time, and the most recent little wiggles down are based on expectations changes. And so again, we're modestly lower, but if we go into dig a little deeper into what Wall Street's forecasting, expectations are still for overall sales to grow over the next 12 months. So no real concern, broadly speaking, of recession. And so that's sort of, we take where expectations are. And then the other thing that's important is, well, what do we have to pay, right? Like if valuations were really cheap, I probably don't have to worry about being disappointed on expectations. And this I go back to 2011 when I was giving an overview, and there was a lot of uncertainty on the horizon. Was the the early recovery after the financial crisis, was that going to get snuffed out by the sovereign debt crisis in Europe or the debt downgrade in the US? And at that point, I used the metaphor of, given where valuations were, if something bad was going to happen, the experience was probably likely to be, equivalent to falling out of a first floor window of your house. You might get scraped up a little bit, might need a trip to urgent care, but your day was likely going to go on just fine with maybe a scrape or a bruise. Today, where valuations are, the margin of safety is a lot less. And here we've just plotted out the cyclically adjusted PE, or CAPE, which tries to normalize earnings for where we are in an economic cycle. And I think the takeaway is, right, on the one hand, to continue the falling out of the window metaphor, we're not not where we were at the start of 2022, let alone the peak of the tech bubble in 2000. But we're still at a point where should these risks to the economic outlook come to fruition, we'll call it falling out of a second story window, where this one might require a trip to the ER. Still going to most likely survive, but it's going to be a bit more painful. And so in light of this, what we have done in our portfolios is decrease our overall exposure to stocks, and really picking our spots carefully. We still see opportunities. Again, we're not at those levels. Again, going back to, let's say, the peak around the tech bust in 2000, but we're at levels that we think warrant some additional caution.
Right, and what you're touching on there, Chris, is just that need to really be flexible and to have that active management is the essential part, as you're sort of trying to avoid the falling out of the window, right? You want some additional flexibility to kind of pad the fall a bit. And this slide here is using our long-term growth strategy as an example, and it has a midpoint of 55%, as you can see on that green line that goes across the slide. But from the financial crisis, if you just kind of walk through the play this out in the timeline, I guess, is with the financial crisis through the 2010s, the long-term growth strategy was above midpoint, and there were many growth opportunities at the time coming out of that crisis, and also interest rates were extremely low, so it was an attractive time to own stocks. As the market continued to run on that momentum of a long bull market, we grew more concerned and reduced exposure to equities, going below the strategy's midpoint at times, as you can see there in the middle of that timeline. We knew that there were meaningful excesses, and the party couldn't go on forever. 2020 came along and COVID changed everything very quickly. So with the challenges that created, we increased equity exposure to take advantage of the downturn in areas then, and then started reducing exposure in late 2021 as the excesses began to build again. So now you can see that we're underweight now, and to Chris's point about they're just needing to be flexible there and kind of monitor and react to what we're seeing in some of those different areas, and then with what valuations are telling us.
Yeah, absolutely. It is worth noting, right, that today, and if we were to update this chart through the most recent data that I have in my hands, our equity exposure in these, in this portfolios is around 47%. So maybe a little lower than where this last tick is that we've got. But what's important is that still there's 47% stock, right? We are still finding opportunities. And so I think it's easy to get sucked into some of the, concerns that we have over the short to intermediate term, but it is worth, I think, spending a minute here if we go to the next a slide and talking about the fact that there are opportunities out there, and this is we think we have to be very very careful, very selective, both in terms of the companies and then in terms of the weights they receive in the portfolio in light of the risks. But just to touch on a few of the themes, and so. One, and this is something that we've talked about in prior webinars and other conversations, and so we won't dwell on this for too long, but this idea of platinum profiles. So these are companies that fit what we consider our strategic profile strategy. So think, strong moats around their business. These are well-positioned companies. These are companies in areas that have long
I think we got Chris frozen. We'll give a minute here. We'll have him back online with us. Apologize for this. Making a point about some good opportunities, so we don't want to move past that yet. This is a good part of the webinar. Give us a couple more minutes. Sorry about this. You're back?
I'm back. How long was I
Alright.
frozen?
You were on a good roll there. So we just waited for you to come back so you can talk about platinum profiles.
All right. So this is a topic that we've covered in some of our prior webinars, and these are some of the some long-held themes in the portfolio, but generally looking at companies that are well positioned in as much as there's strong sort of moats around their business. These are companies that there may be few substitutes for what they offer. Companies that have what we call pricing power, where if their input costs go up, they can pass that on to their customers is higher prices. And so these are companies that would come from areas like consumer staples, certain segments of the technology and healthcare universe. And again, as I mentioned, if wasn't cut off, generally we consider these our profile businesses, and it's these are the types that generally, when the economy rolls over, while very, very, very few businesses are immune to economic activity, these tend to be less sensitive. But what I think is really interesting is areas in the market, and there's not many, but there are some that have already been impacted by the backup in interest rates that we've seen, as well as individual cycles in their industries. And so there are three of them that I just want to touch on briefly are semiconductors, microchips, housing, and insurance. And starting with the semiconductors, we go back to early mid 2020, when all of a sudden the world is working from home, and demand for laptops, monitors, tablets, everything goes to the moon, and you need chips for all that stuff. And so all of a sudden, in short order, the demand for microchips soared, and companies responded. And what tends to happen in cycles where there is a sort of boom bust dynamics is after the boom comes a bust, and that's really what we've gone through, where companies kept cranking out chips, and all of a sudden demand rolled over because everyone refreshed all their all their tech gear, and all of a sudden chips started piling up, and so pricing got very very ugly, and we saw the prices of these companies react accordingly. So this has provided some opportunities in our portfolios to invest not only in the companies that produce the chips, but also the companies that sell the equipment that goes into the chip production. Another area, housing. So we had the chart a couple slides ago looking at what's happened to home sales as rates backed up. And so while people are, this is another way of saying, people are staying in their homes longer. And so that is going to create, likely additional demand for, for folks that, that produce, some of the products that go into home improvement, as well as tools that are utilized in that process. So, while we're not necessarily, going towards home builders and the like at this juncture, we are starting to see some opportunities at the margin to dip a toe or two into some of the building materials and tools that we think are likely beneficiaries, regardless of what housing turnover looks like going forward. And then finally, the last would be insurance. And insurance is an industry that, if you think about, what they do, a decent portion of their, earnings over time can be driven by their investment books, as they have to, hold, premiums, in reserve for potential outlays, as they, events warrant in the future. And so there's often a lot of fixed income exposure in these portfolios. So we've seen insurance companies get clipped on their bond investments. At the same time, what has been over the past couple of years a pretty difficult environment in terms of natural disasters and claims has created some additional stress for insurers. So typically what happens is we will get to points in the cycle like we are today that create some opportunities where investors, after a period of all sorts of bad news for insurers, really give us what we think is an attractive entry point to start again nibbling on some of the more attractive opportunities in that space. Finally, I would just go thinking about that chart of allocation that Dana had up, noting that we are at a lower exposure to stocks similar to 2018 into 2019. The good news this time is, unlike then, bonds are actually doing some of the heavy lifting and returns, as Dana mentioned. Here we just look at where bond yields were for everything from 1 month treasury bills all the way out to the aggregate bond index, corporate bonds, high yield debt, and compare that to what the prior average 5-year average has been. And and really across the gamut, yields are materially higher. So the bad news, while we're seeing fewer opportunities in equities today than we have, instead of settling for 1%, maybe less, depending on the maturity and fixed income, here we're actually getting some returns that are material in terms of reaching long-term return assumptions.
Right, and Chris, I think I have a planning background, and I mean it's a good investment approach anyway to stay the course, but certainly from kind of a planning mindset, it's you don't want to overreact. If your goals have remained the same, you don't have any significant changes to what your personal circumstances are, your time horizon hasn't changed for when you need your assets, you need to access your assets more regularly, you can really stay the course. And it's important because we've talked a bit about kind of concerns that you're seeing, but there still is light at the end of the tunnel. There's always something on the other side here. And the concern with overreacting is, to a bad period of time in the markets, you can then miss an opportunity to participate in the recovery. And this slide here is a list of the recessions going back to the late 1940s. And the second column is from the left there is the max drawdown during that time. So you can see that almost across the board, The max drawdown would be the largest decline during that time in the market. But you can see that on the next columns next to that, toward the right, you can see that there was meaningful recovery and performance over the 1, 3, and 5 year periods. And the one time, maybe the one exception was, you could see toward the bottom there, 2001, and that was shortly after 9/11 and when the war in Afghanistan started. So, but really, as there are significant drawdowns in tough times, that creates opportunities, and you can see where over long periods of time, even 5 years after that, there is some stronger performance, and that's an area that you don't really, as an investor and just in general, you don't want to miss that. So if we look also at this slide here, this is more, if you just think about our current cycle, where we are right now, starting at the beginning of 2020. That's shortly before COVID, and you can see that returns, maybe surprisingly for some people, if they're seeing this, returns since that time have been positive, and even meaningfully so, despite experiencing a global pandemic that ground economies to a halt in 2020 and all areas of the market struggling last year. The gray bars in this illustration show what the market has done over a range of multiple asset class strategies. So if you just take a mix of different multiple asset class benchmarks, that's been the performance over that time period. What we're proud to highlight here is the strong relative performance we've been able to generate over that time in those green bars, and that's our different multiple asset class strategies. And this is due to active management, right? It's having flexibility to move into areas of opportunity, and as some of the things that Chris was just talking about, and avoid areas of risk throughout cycles. And in addition to utilizing this disciplined investment approach, it's important to incorporate proper planning to monitor goals, how those personal goals are tracking over time, and discuss planning strategies that can inform not only the investment decisions, but also the key goals that may not be tied directly to the market and your own investment portfolio. So that's the last of our prepared comments. This is just some of the backup to that illustration. But Chris, thank you for your insights today as we walk through that. Before we turn to the open Q&A, we want to make sure that listeners know that if you have any questions not asked today, feel free to reach out to your financial consultant if you're working with one, or if you don't currently work with one, contact us and we'll be sure to have someone reach out to you. With that, let's get started on some live Q&A. We had some questions came in, pre-submitted questions, so we can take a look at those, and also anything else that you'd like to ask here. And we look to select questions that are kind of broadly applicable to the audience, not too technical maybe, but please submit any and all. I mean, if your question isn't answered, we'll have someone follow up and reach out to you to answer that question, and with whatever it is, we'll be sure to answer every single question that comes in. So with that, let's see, we'll start with just looking at the chat here. I guess the difference, one question was just the difference between focus blend and oriented. I don't know, Chris, if you just want to answer that quickly as I see that.
Sure. So that is so those are two of our balanced investment mandates. The equity oriented blend is just the higher of the two in terms of the midpoint allocation. So equity oriented has a midpoint to stocks of 85%. Versus equity focused blend, which has a midpoint of 70. So that is the difference between the two, just ordered from in that exhibit from most conservative in terms of the equity midpoint and range to most aggressive.
And there's a question in the chat too, Chris, just about we talked a lot about recessions, but I guess just our own definition of a recession. I guess what we would want to, how we would want to define that.
So I will paraphrase. There's a great piece written a few quarters back Howard Marks. Great read, great blog. If anyone's looking for content beyond us, there's no monopoly on good ideas. But he's a long time investor, and he it described recessions are nerve-wracking. Recessions are periods of meaningful economic pain. If we were to go back to the first chart, Dana, you spoke to, with the unemployment rate, right? When the unemployment rate is going vertical, you're at 3% 1 month, next month you're at 4% on your way to 5, 6, 7. That's nerve-wracking. That's that is, would consider a real recession, right? There are technical definitions. The sort of the popular definition that is I think most widely known as 2 quarters of negative GDP growth. Technically, we had that in in early 22 against a backdrop of sub 4% unemployment. So do you want to call it a recession? Don't you? I don't. Like, it's in some ways I think it's less relevant, particularly if we don't have the actual pain, right? We didn't see defaults and bankruptcies tick up. There was none of the other sorts of pain points that tend to occur around a real recession. So if for example, if we were to get to a point where GDP doesn't go negative, but we see unemployment jump up 2%, I think that would qualify for a lot of people, particularly the folks that made up that 2% increase in unemployment, a true recession. So, for us, we focus less on the technical definition and much more on what does that mean for earnings, and and then beyond that, where are valuations, and and are we at a point where we are going to be rewarded for for taking risk in stocks or not?
Right. And there were a couple of questions related to sort of the magnitude of a recession. Not that we can predict the future, and we don't know that, but questions about our expectation for how deep of a recession is that something that we expect that to be a real concern, or maybe less of a or not as much of a deep recession as maybe in past recessions.
Sure. So I think if we're looking at prior economic downturns for potential analogs, I would resist the temptation to look at our last 2 experiences, which was COVID, where basically the global economy hitting a brick wall overnight, as well as the global financial crisis, which was a long, painful, deleveraging experience that lasted years, and was a true a crisis of the broad financial system, and really it was felt everywhere. Instead, this time, I think what is likely to happen is it's going to depend on where you sit in the economy, what your experience is going to be. I think, for example, if we go to one of the clear pain points that's already I think almost inarguably in recession is commercial real estate, particularly office real estate. Right, this is an area that has been hard hit, and even as folks continue returning to the office, the general the general tone has been folks 2-3 days a week. You hear stories of large cities, those downtown cores being ghost towns on Friday, and Monday not being all that much better. And you think about, what does that how does that factor into real estate values? Well, if you're one of those tenants on the first couple floors with retail space, it's a lot less compelling if 2 days of the week you have no customers and companies, as you deal with more flexible work schedules, less demand for maybe having an office that can fit everyone at once. And so we're seeing a lot of pain there, and that could take that could take a while to work through. On the other hand, we think about the consumer. The consumer's gone into this cycle considerably in better position than than they were in 2007, 8, 9. In terms of both the overall leverage as well as the the labor market backdrop, given how how tight labor supply has been, and a lot of that is really due to demographics as we continue to work through the retirement of the baby boomer population. There is a real likelihood that companies may choose to, well, in the past, maybe you laid off 15% of your labor force. Maybe this time it's only 10, or maybe it's only 7.5, as you are willing to bear some pain, but sacrifice some profits over the near term with a longer term perspective that, hey, I want, this is hard to, it's hard to hire, and it's really hard to hire good people that are going to stick with you. So, perhaps we don't see unemployment, skyrocket this time. Maybe it peaks at 5 or 6. So, I think it's those types of things. And so, from an investment perspective, we think this is really interesting because as we go through, the cycle, there's likely going to be a rolling set of opportunities. It's not going to be an all or none type of thing. So, getting back to some of those areas where we were seeing some examples of pain and being able to respond with investments.
Yeah, that's good. And I think another interesting question that came in was related to short-term fixed income. I think just based on what the yield curve looks like right now, and the inverted yield curve, I should say, and the fact that I guess the question just is, well, why not just own very short-term bonds instead of going out longer into longer maturities? And I guess there's a couple different ways to look at that, probably, and I'll just address sort of the planning perspective. But I guess if you have a very short time horizon, then that you're dealing with here, a couple of years that you may need to invest for and focus that way, then sure, maybe having more of a short-term focus can be good. It could be a good approach, right? Because you're just kind of aligning what the time frame with your cash flow needs and what you expect from a goal standpoint. But I guess there's probably, from an investment, if you really think about it, even if you have more of longer term goals, like why, as an investor, why wouldn't you want to do that, Chris?
So when we think of bonds in a portfolio, there's two elements. One is that current income that it's going to generate for us, which is important certainly for those that are inclined to spend that income or required to spend that income. But then also fixed income, particularly as we start to get out to longer maturities, can provide an important ballast to stocks in a balanced portfolio, particularly during recessions when growth slows. And generally when growth slows, interest rates come down, and as interest rates comes down, just by the math of bond returns, falling yields is good for bond prices, right? Last year we lived through the other the unpleasant part of that bond return math. Rising yield, all else equal, is going to hurt prices, as you have to mark down those existing bonds to compete with new issues that are struck at higher yields. And so but that was an environment really driven by inflationary concerns. And as we look with this particular the overview that we have and the risks that we see, as these risks unfold, growth is likely to slow, and with growth slowing, inflation as well. So we think that bonds have the opportunity here to provide both income, which is important, as well as some capital appreciation as rates fall. And I think what's important is our approach to fixed income is not simply to ladder out a bunch of treasuries or buy and hold, but instead we're active. So we're thinking about our investments in fixed income, really very similar to stocks. Where are we getting the best opportunities for the risk that we have to take? So we have been having discussions, the fixed income team has been having discussions on, as we start to go through, what areas of the bond market would we want to rotate into? So going from a very high quality areas to taking on a bit more a bit more credit risk should we see opportunities in the form of wider credit spreads, which is to say folks all of a sudden start demanding an extra premium to lend to lower quality borrowers. So as that type of stuff happens, you would expect us to rotate and be positioned to take advantage of that.
Yeah, and I think there's a related question that was asking about one of the pre-submitted questions. That was just sort of the outlook for bonds and percentage of conservative portfolios. I guess what percentage is what they're asking. What percentage of portfolios should be in bonds? And I guess I think it's again kind of a planning discussion there, where there's also the time horizon, right, and risk tolerance. And I think if you are an investor that has a longer time horizon, 10, 15, 20 years certainly out, I think it's still and the goal is to grow your portfolio, then owning a meaningful allocation to equities is going to allow you to generate the growth that you need to achieve your goals over time and generate that growth in your portfolio. And as if you're closer to your time horizon, where your retirement or whatever you're targeting there, then maybe certainly a higher allocation of fixed income to dampen volatility makes sense. And if you're looking at more of an active allocation, like the way Manning & Napier manages, and we have a range of where we adjust throughout that allocation, then we're going to make decisions there as a manager to where that value is, like you were just touching on there, Chris, as far as, well, maybe a little bit more fixed income makes sense in the current environment because of what it is providing, versus having more allocation to equities in that regard.
Yeah, absolutely. I think well put. Nothing to add on my end to that one. I'll take one that we've got a couple questions, and I think they're very much related, and really getting after the same thing, which is the trend that we've seen over really the past couple decades, where the dollar, while still the dominant currency worldwide, as we think of foreign exchange reserves or currency trade is settled in, it's it's steadily faded. And so the questions center around some of the recent moves by the BRICS nations, as to start to move away from the dollar, particularly for settling bilateral trade amongst each other. And what does that do as the should the dollar lose its reserve currency status over time, and how do we hedge against that? And so it certainly just happen to have some data in front of me, some work some other folks on the team had done recently. If we went back to 2001, the dollar represented about 73% of international currency reserves. Through the end of 22, that's down to 59%. So the dollar is still massively important, but certainly the trend is pretty clear. As far as when might this happen, where that number goes, south of 50, or further down, where it's not the winner in a plurality, but it's actually outright outranked by others. Expectation would be slowly. I mean, if we go back and look to history, I think the pound is arguably the last reserve currency, or prior to the dollar's ascension. And there again, that took many decades to get there. And part of it is just the availability of alternative reserve currencies. Of what for example, the Chinese currency, they still operate, the renminbi is a closed currency. So there are issues to broad adoption at this point. It doesn't mean it can't change, but for us, from an investment perspective, what we focus on is what are those opportunities? So should the dollar be in a period of extended weakness, that is going to translate into strength for non-dollar denominated assets, which is to say international equities. And so when we look to make make investments in our portfolios, unless it is a portfolio that's restricted to U.S. only stocks. We operate with a with a global mandate. So wanting to have a diversified portfolio of both in terms of the companies and sectors, but also geographies. So the international exposure can be a great hedge to that. As that unfolds, and it doesn't require a directional bet on a currency, right? This is, hey, we found a great company. They happen to be priced in euros or yen, or Aussie dollars or Canadian dollars. It doesn't, but first and foremost, we're looking for great businesses. But the additional benefit that we have is by identifying those great businesses outside of the U.S. or great investments, if we're talking about cyclical areas, is that should the dollar weaken from here, we're going to capture some additional benefits in terms of currency translation.
Great. I think that it's like that we've covered most of the submitted questions. So unless you see another one, Chris, I think
I think we're good. I think there was one other one, and maybe I'll paraphrase it a little bit, and we can follow up to make sure we hit the mark, or if not, we can go a little deeper. But basically, someone asked, how do we think about reconciling our outlook, which is one of recession being a base case, and additional downside risk to stocks broadly from here, versus others that may have a more optimistic view of the world, and whether that's a base case of a strong bull market, or sort of the soft landing or no landing type of camp with regards to the economy. And I think there it's a interpretation of the data as we see it. I think one of the bull cases out there hinges on the idea of the Fed cutting rates, and that being a nice tailwind of lower interest rates, pushing risk assets higher again. We've gotten to a point where the yield on even short-term treasury bills is pretty comparable to the earnings yield on stocks, and more than doubled up the dividend of the S&P 500. But all of a sudden, if that falls again, you're going to push people further out the risk spectrum. Our perspective on that is, when we go back and we look at when the Fed has cut rates, they generally don't cut rates because everything is going fine. They generally cut rates aggressively in response to real challenges, real pain in the economy. So we think that should our base case come to light, yes, the Fed is going to cut rates. And when we go back and look at the history of rate cuts, what we see is one, it's generally not the first rate cut that gets the market moving in the in the right direction. There can be pain for for an extended period of time. And so, we would view the rate cuts that the market, the bond market is pricing in, if we look at Fed funds futures, as a sign that there's additional risk out there. So we're not, we don't see as a base case you're going to get rate cuts just because inflation has leveled off. Because again, we think about the mandates of the Fed, right? It is price stability, full employment, and the lesser publicized one is reasonable borrowing costs. And we can debate if 5 or 6%, or I guess 5% on the short rate is reasonable. But certainly, we go out to the long end, the yields aren't particularly a challenge there for borrowing costs. But right, we think about the main two mandates. Full employment, we have full employment. There is no there are no issues if we're looking at unemployment at this juncture to say we need to cut rates to get people working. And so you can focus on price stability. And while inflation has come off of those high numbers, driven by in many cases the sort of the transitory part of Jay Powell's inflation story going back a couple of years, there's still some structural issues, not the least of which has been wage pressure that's still left to deal with. So we think the Fed's still in a position where they have this delicate dance to do between balancing the need to tamp down some of these perhaps more embedded inflation pressure, while keeping an eye on the labor market. And really, I think until we see some pain there, it's difficult to expect them to react. Even if we look at what happened in 2022, right, there was always the talk of, well, if the equity markets sell off enough, maybe they'll intervene. Not only did they not intervene when stocks fell 20% off the peak, they then immediately proceeded to hike several more times. So I think the Fed put is maybe not as much of a put as it once was. That being said, I think the other case where they would intervene is if we were to see a real seizing up of the monetary plumbing, which again, not really a highlight for risk assets. So we're less excited, I think, about the prospect of the Fed cutting rates, all else equal. I think the other way that you could get a soft landing, or just continue to plow on through, is we need productivity growth. And again, this is one where it's from our perspective, it's hard to see that as a real big tailwind in the in the short to intermediate term. And now maybe we go years down the line, and the generative artificial intelligence, so the chat GPT is the example that's certainly been in the news. We've had a few no formally submitted questions, but certainly it's come up in conversations with clients as to what this means. And I think it's very, very early days, but it's there's no reason at the end of the day it could not be a very powerful tool. But again, looking back over history, the internet probably being a great example, it takes generally a extended period of time for folks to figure out how to how to use that how to use that properly, how to use it to actually gain real productivity improvements. And so maybe that's out there on the horizon, but for the time being, it seems like productivity growth is likely constrained, so we're not looking for that to bail us out. And again, those are just a couple, but I would love whoever submitted that question, if you want to reach out, love to see what the case they're espousing is, and be happy to dig in and provide some more of our perspective.
Great. I think that'll be where we wrap it up here. Thanks again, Chris.
Thank you. This was great.
Yeah, and I want to thank everyone for taking the time out of their day to be here with us. We greatly appreciate it if you can take a few seconds to fill out the survey that should be linked in the chat. We've just to give us your feedback. It's always important for us to know how we're doing with this content and with these webinars. As a reminder, a recording will be emailed to you shortly, and if we didn't have a chance to answer your submitted question, we'll be sure to follow up after to answer that question for you. Or if you'd like to follow up with an additional question you didn't have a chance to ask at all, certainly reach out. Please register for the content Manning & Napier creates, covering a broad range of planning and investment related topics. We do produce a significant amount of material that addresses topics you may find interesting and helpful. And also, if you're interested in learning more about Manning & Napier or wealth management services, please visit the link on the screen that you see right there, and you can schedule a call. So on behalf of my colleague Chris and Manning & Napier, thank you again and have a great day.
Thank you.